Hello and welcome to CNBC-TV18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. Joining in today, we have one guest but two topics. Ashish Shanker, Managing Director and Chief Executive Officer at Motilal Oswal Private Wealth joins in, who'll first talk about how to invest in a scenario of rising bond yields, and later on we'll also talk about how to invest in this time of global volatility and what should be your portfolio positioning. So Ashish, thanks very much for joining in. First, let's talk about this scenario where bond yields are rising. RBI has increased the repo rate by 50 basis points last week, and all indications are that probably more rate hikes are coming. So is it the time now for investors to look at ramping up their fixed income portfolio?
Yeah, first of all, Sumaira, it's always a pleasure to be on your show and talking to your viewers. So yes, you're right. Things have been quite volatile. Rates have been rising, and it's not just put pressure on loans, but it's also I think it's a good time to review fixed income portfolios and see whether people are rightly positioned. See, what happens typically in a rising interest rate scenario is funds which have longer maturities. When I say longer maturities, I'm talking about funds which are more than 5 years, 7 years. They tend to show a negative return or lag, because as rates rise, bond prices tend to fall. They are inversely correlated. So first of all, I think people need to have a clear understanding of this. Otherwise, what happens is when you look at your portfolios and you see fixed income funds showing negative return, it can lead to panic, because we have not been used to fixed income portfolios giving negative returns. The second thing is, if you look at the yields, today repo is at 5.9, and our view or estimate is that we will see a peak repo rate of about 6.5. So which means that RBI is not yet done with interest rate hikes. Of course, there is always some ambiguity, reason being that RBI's actions are driven by what global central banks are doing. And if global central banks do change their stance, then RBI will need to be that much adaptive and change accordingly. So that will determine the course of interest rate hikes over the next 6 months to a year. But as an investor, what you need to do is clearly in this kind of a scenario, ensure that your fixed income investments are aligned with maturities. As I said, typically what happens is when rates rise, your portfolios tend to react negatively in terms of price. So for example, if I have a horizon of less than 1 year, you need to align portfolios accordingly. So less than 1 year, you have liquid funds at the extreme short end, and then you have ultra short-term funds the moment you have a time horizon of 6 months plus. Now, these are very good funds in the shorter term because they also act like floating rate funds. See, what happens in a liquid fund is the maturities keep getting renewed every 15 days or 1 month. So as rates rise, you'll automatically get the benefit of rising rates. Similarly, in an ultra short, what happens is that your maturities get renewed every 5 to 6 months. So as the papers mature and new papers are bought, and if you're in a rising rate scenario, you automatically get the benefit. The moment you have a 3-year plus horizon, then you need to accordingly have funds which have maturities between 3 to 5 years. So I think in a rising interest rate scenario, it's very important to align your portfolio maturities with the underlying funds. And this is a great time to relook at your portfolio and see whether you're adequately positioned. Remember, just a year back, yields were about 1% lower. And at that point in time, the concern was whether clients are beating inflation. You had very, very low rates. If you remember, bank deposits were between 4 to 5.5%, even at the long end. And inflation typically in India runs anywhere between 5 to 6%. So we were actually getting a negative real return. But today yields have gone up very sharply, and one can argue that the current inflation rates are probably transitory and they will come down. So fixed income is offering a very, very attractive return today. And for a lot of the investors who probably move towards riskier asset classes because they wanted to make a slightly greater return, it's a good time to relook at their portfolios and see if they can make a higher return without compromising too much on risk.
Okay. So Ashish, then going by what you're saying, what kind of funds and strategies would work well? Is it better right now to stick to the debt funds which are on the shorter side, maturities up to 3 years?
Right, that's a very, very good question, Sumaira. So typically, like I mentioned, in a rising interest rate scenario, if you have funds with very high maturity, you tend to get negative returns. And the reason for that is very simple. Bond prices are negatively correlated with interest rates. So when interest rates rise, bond prices fall. And the longer the maturity, the prices of bonds fall more. So that is one point. The second point, Sumera, is also to see where which maturity the return is the most attractive. So what has happened? Let's try and study what is currently happened in markets. As repo rates have gone up to 5.9%, the 1-year government security currently is yielding 7%. The 5-year government security is yielding close to 7.3%, and the 10-year is yielding between 7.4 to 7.5. So really the market is not giving you any premium to increase your maturities beyond a point. See, typically what happens is that the longer you lock in your money, you want higher returns, because the longer you lock in your money, the risk increases. However, today market is not offering you that risk adjusted return. Reason being that people expect longer term inflation will come off. So that is the reason the longer end or the 10-year paper has not moved as much as the short term papers. So we believe one should do two things in a fixed income portfolios. First of all, you should match your portfolio with the underlying maturity that you expect. So if you have shorter term money, anything below 3 months, you should not look beyond liquid funds. And liquid funds are also offering very, very good returns. They are closer to 5.5% net yield to maturity. The moment you have a horizon of 3 months to a year, you could start looking at ultra short term funds. Even arbitrage funds are now giving higher returns, because the rollover spreads have increased in arbitrage funds to closer to 6%. And arbitrage funds offer you a tax advantage as well. The taxation is more like equity funds. Now, for longer term investors, people who have a horizon of 3 years and beyond, where you get indexation and superior tax efficiencies when you invest in mutual funds, for those investors, currently we are advising them to invest in funds with a close to a 5-year maturity. As I said, the difference between a 5-year bond and a 10-year bond today, the yield difference is not much. It is 10 to 15 basis points. So going to 10-year maturity is not offering you that risk return benefit. So a 5-year target maturity fund is what we are recommending. What happens in a target maturity fund, it's important to understand that if you invest today, the average maturity of the fund will be 5 years. And after 3-4 years, when you probably need liquidity, or when you need your money back, at that point in time, the portfolio maturity will be closer to 1 or 2 years. So you not only accrue the underlying net yield, which currently is closer to 7.1, 7.2, you also can end up making a little extra return, because by the time you cross 3 years, the maturity of this fund comes down to about 1.5 years, and the 1.5-year yield is lower. So you get a slight capital gain as well. So this is what we are recommending, Sumera. And other than that, there are other options available in the market, like NCDs, bonds, perpetual bonds. These are all yielding higher returns. But if you look at from a tax efficiency point of view, probably these mutual funds, targeted maturity funds, offer you the best bang for your buck.
Okay. So Ashish, by when can we expect that debt funds will start giving returns, and what might be a range to work with?
Right. So as I said, this rate hike cycle, we believe, will be a little shallow in the sense that if we are projecting the terminal repo rate to top out at 6.5%, then we are talking about another 0.6%, which can happen as quickly as the next 3 to 4 months. So I think the next 3 to 4 months offers investors a great opportunity to lock in their yields from a 3 to 5 year point of view. And I do believe that even though in the last 1 year, some of the longer term funds, debt funds in client portfolios may have given flat or maybe even marginally negative returns, will start accruing at a faster pace. So next 1 year, I expect debt funds to give much higher returns than what we have seen in the last 2 to 3 years. So really, the next 3 months will give you an opportunity to lock in much higher yields. So it's a great time. Again, I'm reiterating that it's a great time to review your fixed income portfolios and ensure that you are adequately allocated. Because a lot of the investments you might have made in the last 2 to 3 years, or maybe 3 years back, may have become long term in terms of the tax treatment, and it may be a good time to relook at your portfolio and realign it with much higher yields. So if you look at the net YTMs from a 3-year plus point of view, they are upwards of 7%. So like I explained, if you put it in target maturity funds, you not only make the 7% accrual, but you could end up making 0.2 to 0.3% extra because of the roll down effect. So 7.3 to 7.5% is something that you could expect in longer term debt funds if you position your portfolio appropriately.
And finally,
And mind you,
yes.
no, I said mind you, and these are extremely high quality funds. So there is absolutely no credit risk. I'm talking about a five-year target maturity gilt fund, which can give you 7 plus today.
Okay. And finally, any practical tips that you want to share about building or bolstering the debt portfolio?
Yes, so I think one of the things is to ignore the noise. I mean, there is a lot of noise. If you actually look at the news today, you hear a lot of conflicting news. I mean, you have some geopolitical tensions happening around the globe. You have all the large central banks trying to raise rates. At the same time, there is talk of recession, and there is talk of oil prices going up. So a lot of this news flow can be quite contradictory, because on one side, if you feel that the world is going to head into a recession, you cannot have higher oil prices at the same time. So if you read a lot and if you listen to the news, I think it can be very conflicting. Instead of that, I would say that you should focus on your own portfolio. You should look at what is the maturity of the underlying funds that you have in your portfolio, and accordingly allocate capital. And if you allocate capital accordingly, I don't think that over the next 3 to 5 years you should have a problem in terms of returns, and the volatility will gradually abate. So near term, I expect a lot of volatility, but I do believe that the volatility will gradually abate over the next 5 to 6 months. And this next 3 months, you must use this opportunity to lock in attractive returns in your fixed income portfolio.
Okay, Ashish, stay on with us. We're going to take a quick break. We'll come back with Ashish in a bit, and we'll talk about, how to better prepare yourselves in the face of this global volatility. Stay tuned. Hi, welcome back. With us, we have Ashish Shanker, who's the MD and CEO of Motilal Oswal Private Wealth. And we've spoken about basically how to invest in a scenario of rising bond yields. And the other thing that investors should keep on their radar is basically how they and their portfolios will be affected by the global volatility. So, Ashish, the first thing is that, should investors prepare for further incremental volatility in the global markets?
Yes, Sumera, I do believe that we will see a lot of volatility in the months ahead. And the reason is there are various factors at play. The biggest central banks in the world are trying to tame inflation by raising interest rates. If you look at US, I mean, the home loan rates of US are very similar to what they are in India. And some of these economies are already in a recession or heading for a much slower period of growth. At the same time, the geopolitical tension around Europe is not helping. It is putting pressure on oil and gas prices. So this is a classic setup for heightened volatility. So first, investors should expect volatility. I think half the challenge is expecting, and actually if you expect that there is going to be heightened volatility, then you can start addressing how your portfolio should be positioned. So I do expect a lot of volatility over the next 3 to 4 months on global factors and certain India specific factors, as well as we also head to much higher rates from a policy point of view.
Okay, so Ashish, portfolio-wise then, what kind of changes are recommended both in terms of, capital protection and generating returns?
Right. I think these are good periods to actually relook at one's investment charter. I mean, we normally recommend that for any portfolio, you should actually build a charter which tells you what is your longer term return objective, and accordingly what should be your asset allocation between fixed income, equity, gold, or international investing. And once you get a hang on how the portfolio should be allocated, like for example, if there is a conservative investor and he or she wants to have 70% in fixed income and 30% in, let's say, riskier asset classes, then you must revisit that and ensure that you are closer to the desired asset allocation. I do believe that a lot of people had strayed away from fixed income and probably started taking higher exposure into risky asset classes because the interest rates were lower. But now with yields being attractive, I think it's a great time to relook at the asset allocation and ensure that it is in line. So I would say that ignore the near-term noise, prepare for volatility, but at the same time, you should stay focused on the longer-term picture, as even fixed income is offering very, very good yields today. So I think getting the asset allocation right and positioning it as per your longer-term objectives is 80% of the battle won during a volatility.
But generally, Ashish, is it time to be more conservative, or is it time to maybe show a little bit of aggression portfolio-wise?
I think it's a time to be a little conservative, and it also depends on the investor's temperament, right? Probably risk appetites had gone up over the last year or so because fixed income was not yielding too much return. But for people who are, let's say, who cannot stomach volatility, I think it's time to be conservative because fixed income is also offering you good returns. So that would be my advice.
Okay. Another issue, Ashish, how can investors hedge their portfolios against this, two key risks? One is volatility and the other being inflation.
Yeah, so two approaches to hedging volatility. The time-tested approach is to have a multi-asset portfolio, which means that do not be over-allocated to any asset class, right? So you have Indian equities, you have international equities, you have fixed income, and you have gold. Typically, we recommend that you have some exposure to each asset class. I mean, gold obviously is a classical hedge against volatility, or it is a classical hedge against any geopolitical risk. It tends to do reasonably well when equity or risk asset classes don't do well. So I think getting your allocation to multi-asset classes itself is a hedge against volatility. In fact, we run an equal weighted portfolio to each of these asset classes: international equity, domestic equity, fixed income, and gold, and we rebalance it every year. So one is having a exposure to all these asset classes and rebalancing it at a regular basis. That itself is a hedge against volatility. Second, at a portfolio level, one needs to ensure that you are rightly allocated. Like we discussed fixed income at length, as to how investors should position their portfolios. Just matching maturities with the underlying products itself is a hedge, because you end up getting a return that the portfolios are positioned in terms of net YTM. Similarly, in equities, I think it's a great time to be in high quality strategies and ensure that the portfolio is allocated in high quality stocks or mutual funds or whatever product works for you. So I think having both these in place gives you a good cushion against any global volatility.
Ashish, thank you very much for joining in to talk about both of these interesting topics, and very timely, I must say too. So thanks very much indeed. With that, we're going to wind up on this edition of MF Corner. Do stay tuned. The team of Closing Bell joins you next.